This is the current federal tax development for the week of November the 3rd, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollars, and I'm broadcasting this week again from here in Phoenix. And we have a few things to look at for this week. First, we're going to look at a court case involving a church, or a claim church, that lost its tax-exempt status due to the IRS findings and the court's findings that this thing has significant private inurement and had various operational failures as an entity. So essentially, we'll talk about what went wrong. There was probably very little that went right, to be totally honest, in the case. We're also going to take a look at the interesting rules for getting reimbursed for legal and other fees of challenging the IRS. In particular, the prevailing party statute under 7430. And really, in this case, the importance of this thing known as a qualifying offer. So we'll talk a little bit about that. We're also going to talk about the federal priority statute and how a corporate officer got stuck with a significant liability. A corporate officer who technically had no ownership in this. He was an attorney who was basically formed this corporation on behalf of a client, ended up on the hook for the unpaid taxes of the corporation. We also talk about a situation where it appears that somebody didn't understand what was going to happen when they had an administrative termination of a bankruptcy case. And because of that lack of understanding, or at least according to the court, the fact that they didn't ask for something when they went into that interesting status ended up allowing the IRS to move forward with collection activities, even though the taxpayer, or I should say, taxpayer in this case, thought that, action was stayed pending the completion of their Chapter 11 bankruptcy payment structure. But it didn't work. We're also going to talk about a taxpayer a tax preparer. Now, it took the IRS a few years to figure this out, but this person had been barred from preparing returns in the future. He went ahead and started preparing returns. And now he's discovering that, first thing is the judge in question is not happy with him. Michael Milken could have told you something about this judge because she has an interesting history of cases that she's handled, which includes going way back to Michael Milken, right? If you remember him. He ended up with a bit of a book thrown at him for what's happening there. We actually have a bill that's been passed, not yet signed by the president, but that is going to make some changes to math error notices, basically require the IRS to give clear notices regarding certain items. We'll talk about what's in that bill. All of that talk, obviously, is pending a signature, but there seems to be little reason to believe it won't get signed, though it may get transmitted to the president, which I think may be our issue right now until the House comes back in to transmit it. So who knows how long that takes. But we will talk about this bill. And finally, we're going to take a look at a case where, in essence, in two cases, the IRS effectively argued two different things, on different sides of the same transaction. Now, the actual court cases are separated by 12 years. It's been going on for a while. This situation involved a family dispute, a few other things going on, it looks like. But in any event, we're going to take a look at the rules involving unstated interest. And in this case, the question was to settle a dispute over payments for a merger. There was a payment made to trust that was made by the acquiring company, made to the trust. Back in 2013, the IRS tried to argue that the acquiring company, there was no interest in what they paid, even though it took 2 years for them finally to say, okay, here's the payout number. That basically they're saying nope. The taxpayer won, saying that nope, it really was a sale that was back 2 years earlier, and it finally got paid in this lump sum 2 years later when they finally settled the case. But that had to have an imputed interest component, and that was good news for the buyer, obviously, because that was deductible, even though the actual purchase of the corporations would have given them basis. But Much better to have upfront deductions usually than basis. So we'll go for that. What happens now, like I said, 12 years later, is the IRS now litigating against the trust that received this payment and now arguing, well, wait, what's good for one side is good for the other. The amount you got here should not have been capital gain, but a chunk of it should have been ordinary income, interest income. We'll talk about that case. So let's start out with the church and the private inurement problem. This is the case of Community Worship Fellowship versus United States, case number 19352. This is from the Federal Court of Claims, and the case came down on October the 23rd. Now, in this case, the IRS has revoked the church's 501c3 tax-exempt status. And they did so saying that, well, this organization has, impermissible private inurement and had a number of operational failures, all of which says, sorry, you don't qualify. Now, as a church, they don't need to get basically, any sort of letter from the IRS. They don't have to apply to the IRS for recognition of their 501c3 status. Now, some churches will just kind of prevent any risk of something like this happening, at least protect donors up through the date of the revocation, and make it clear that it was always a 501c3 and always a church, that the service agreed with that. But they don't have to. They don't have to file 990s either. But now they're going back and they've taken a look at this. Now, one of the key issues involved, and this is not just for churches, but any charity, to maintain your exemption, tax-exempt status, an organization must operate exclusively for one or more exempt purposes. And that prohibition is absolute. For a 501c3, it's stricter, right? Very strict. No part of the net earnings may inure to a private individual. A loss of status incurs if even a small percentage of income inures to a private individual. So this is a very strict test. So if in essence we are, part of this operation serves primarily to, or not primarily, but to any significant extent, basically, or pretty much any extent technically, to benefit a private person other than, go forward with the charitable operation, you don't have a deductible charitable contribution anymore, and you don't have a tax-exempt org. So that's a problem. Now, this church, Community Worship Foundation, was primarily controlled by the Goddard family, right, who constituted the majority of its membership during the audit period from 2013 to 2016. During that period, 98%, or $933,000, of check disbursements were traceable to the Goddard family. So lots of money going to the Goddard family from this church. Lester Goddard, who is the founder, determined his own salary and his bonus, which was approved by the members who generally were related to Mr. Goddard. Right? Looks like a little bit of potential issues here. You might see why there's some questions coming up about what's going on here. Now, in addition to that, CWF, basically the church, lacked any written employment contracts with these employees, many who are family members, any written compensation policies, and there were no contemporaneous records documenting services that were performed by these individuals that justified their compensation. Now, it's not private inurement, if you're paying somebody from the charity to perform services and those services are, not being compensated in an amount well beyond what their worth is to the charity. So there's not a problem that, for instance, the church I attend is paying our pastor. But of course, our pastor's family isn't the party all determining, how much he's getting paid. We actually do have an employment contract. We have policies for compensation, and we have records of, what he did, right? We have those records of services that were performed. Pretty good background there. Those are missing here. So what the court found was that, okay, the family controls this whole thing, and Mr. Goddard's the head of the family, right? It was, combined with what was called self-determined undocumented compensation. Remember, Mr. Goddard said his compensation, his bonus, was sufficient to conclude that the salaries by themselves constituted private inurement. And remember, there's no tolerance for private inurement. So essentially, this thing is now in big trouble. Right? The issues was that the Goddard family had complete control over CWS finances, including bank accounts and credit cards. These funds were dispersed for some very interesting personal uses, including luxury items, Prada handbags, furs, jewelry. No real explanation how that advanced the charitable purpose of this church. We certainly aren't buying, Prada handbags, furs, and jewelry, for members of the pastor's family, right? And even ones that are working in the church, right, who may be compensated otherwise. It's kind of tough to see how a Prada handbag works into that, right? That international travel to Paris and Hawaii with no real description about how that related to the church, right? And they made home improvements. They put in a pool slide. Again, tough to see how a pool slide, an improvement to a family member's house, how that somehow serves the church's interest, right? So, and they were using the tax indemnity as a source of loans. They had, in essence, when they needed money, they were going to be taking money out without any recorded terms or conditions. That is a form of private inurement, regardless of whether or not these things get repaid. You're treating it as your own bank account, right? Oh, I need some money for this. I'm going to borrow because part of the defense is going to be, oh well, we're going to repay that. Like, that's not good. And just the basic failure to have any sort of records, in essence, it meant the organization couldn't meet its burden to show its operations did not inure to a private benefit, which meant this thing is not a tax-exempt entity, it's a taxable one, and contributions to this entity are not tax deductible. That can be an overall really, really bad result. So, as we'll say, not a happy day for the CWF, and especially for the Goddard family, I suspect, when this case came down. The next case is a lesson in understanding the concept of a qualifying offer. This is a case of Crystal Greenwald versus United States. This was a civil action, 2:23 CV 4100. This is a U.S. District Court from the Southern District of Ohio. And the opinion came down on October the 23rd. The issue in this case deals with the concept of prevailing party status under Section 7430 for recovering administrative and litigation costs. And in this case, where it's going to become key is the secondary way of doing it via the concept of having made a qualifying offer at some point during the dispute. So we'll talk, that's going to be the key issue here. And it is something you should be aware of because it can actually help, especially if we need to take the matter to court, recover attorney's costs in this case, which is what she did. She recovered her attorney's costs for the period after the qualifying offer was made, right? We had to get that in place. So, although the taxpayer substantially prevailed on the amount in controversy, she did fail initially the primary way you could get this, right? If the IRS was not substantially justified in their position, then the IRS essentially, is going to be stuck with this. They took a flaky position that the court found had no real substantial justification. They were just being obstinate for no good reason. And for that, if that case, you could win this case. You could win the claim. But that's not true here. As the court pointed out, she initially failed to substantiate, right? The requirement of 6 months of residency of the kids with her to qualify for the tax benefit relating to head of household, child tax credit, essential statuses that she had claimed on the return, right? However, here is where it now comes down. The taxpayer qualified because at this point, they made what's called a qualifying offer. And that's covered by Section 7430 C4E. The $0, they made a qualifying offer to the service of, we'll settle this case for $0. The IRS did not meet the timely response to that So later, we're going to discover that when the government got the information and decided to compromise it down and said, yeah, okay, it's zero. Now suddenly she does go ahead and, she qualifies. Therefore, following the qualifying offer, she qualifies for getting reimbursement. Now, what a qualifying offer is an offer to settle, right? It has to be delivered to the office or personnel who have jurisdiction over the case per Regulation 301-7430-7 requires you to do that. Now, in this case, the offer was addressed incorrectly. It was to the P.O. box, but they had information from the U.S. Postal Service tracking system that confirmed delivery to the actual physical address at 310 Lowell Street, which was the address that was supposed to have been used. Therefore, the taxpayer, the court said, even though, yes, it wasn't maybe properly addressed, that's irrelevant if it got there. And basically, it's the same facility. So it got there. And they had proof of physical delivery. Even though that address was listed on the document was a P.O. box, it satisfied the requirement because it got there. Obviously, it would have been better to have been addressed to the street address properly and have the certified mail receipt and other stuff like that. But in this case, even though it wouldn't have qualified even with a certified mail receipt because you didn't have the proper address on it, right? And so you couldn't prove it was delivered. The assumption of delivery would go to that P.O. box, which was related, I believe, the payment address or whatever was going in there. Doesn't matter because you have evidence here from the Postal Service that where they delivered it was to the 310 Lowell Street address. So it worked out for them. Now, so here's the catch. You make the offer. The service has a time period to respond. You must give them, a certain time to respond. They if they respond and accept during that period, then okay, we're done. You're not going to get any costs for before that period. If, however, the IRS lets that time lapse, then what happens with the qualifying offer is if, in fact, the case is ultimately determined, the amount of, owed by the taxpayer is ultimately the amount of the qualifying offer or less, then, we're done. Now, the government said, though, there's an exception. If there is a later settlement of the case between the taxpayer and the government, if there's a settlement, that won't get you the qualifying offer steps. The government offers to settle a case, let's say, for an amount. You really need the court to determine, right? You really kind of need it to move forward. If you and the government enter into a contractual arrangement to do this, then that's an agreement that doesn't really determine who is right. All it is an agreement that says, hey, we have contractually agreed, this ends it, right? You pay us this, we're happy, we all go home. In this case, what the IRS did was simply concede the case. Once the IRS concedes it, that is a finding, right? The government has basically just given up, unilaterally given up on the case. Later, as they got through processing all this stuff and looked at the data and studied the data they'd been given, which they had before the qualifying offer was made, but before they were given the qualifying offer to make a choice on, and they decided then to say, okay, yeah, we concede, we look at this, we know we're not going to win this now in court, because she could show. The problem had been initially, she could document that the kids had, the documents had, what she documented was that the kids were essentially removed from her custody in August. But as the court noted, that doesn't prove they were there from January 1st to August. And we're looking at, the 6 month rule in order to have qualifying head of household, to be the custodial parent, for an income credit, all of those sorts of things. So you couldn't show that. All we know is they were there at, for some time that ended on this date in August, but that doesn't prove that some time was 6 months. When she later assembled that evidence, right? The evidence was presented to, in discovery, presented to the IRS, IRS now has all that, government has all that evidence. Now the fact they sat on the case and kept things going before they finally settled, by simply conceding, that's a problem. Now the IRS said, no, that's like a settlement, right? And court said no. A settlement requires an objective manifestation of mutual assent to the terms, that contract. There is no contract. A government concession made solely because litigation continuance was preferable to concession, it was that way, the way we go in that route initially, lacks mutual assent. It wasn't bargained for. There was no exchange. It's not in a settlement for purposes of Section 7430A4E. And because of that, we still have the qualifying offer. And of course, what they're settling for is zero, right? What they're going to, once the concession is there, she owes nothing. That amounts to a zero determination, a zero result, therefore, in the case under what's a formal judgment, not a contractual one that the court just accepts. But basically, the other side just walks away, right? Obviously, when the other side concedes everything, your side's going to say, hey, judge, they're actually, there's no way they prevail once having conceded all of that, right? Right. So case done. Because of that prevailing status made on the qualifying offer rule, because the IRS was justified, and had no qualifying offer been made, had they just sat there and waited, she'd have been stuck with her legal fees incurred up until the time, that the IRS finally got around to, deciding to concede the issue. But because her counsel had made, and it was a qualifying offer saying, give us everything we want. That can be a qualifying offer. If you're sure your case is strong, that's the other issue I think the court was thinking. Is like, IRS, you should have realized when counsel put this out there, they're telling you they believe this case is obviously going to them, right? That might give you a clue that maybe you should look at this. Okay. They didn't offer you anything. So, if there was a reasonable chance you're going to prevail, why would you settle for that? You'd come back and say, no, we're going to negotiate this and we'll settle it with you for, whatever, $1,000, but you'd approach them earlier. So we'll settle it for, let's say you were going to owe us $7,000. We'll settle it for taking $5,000. We'll compromise. But you just sat on it. And having sat on it, and then having finally gotten around to looking at your data, and having then finally determined that you are not going to have a leg to stand on if you went to court, and you just concede, well, she incurred legal fees. And because of that, she gets the fees. Now, she cannot get fees essentially for expenses incurred on and after, or only for limited fees incurred on and after the day of the offer. Fees incurred prior to the offer, so her representation up until the qualifying offer was made, right? Until counsel came in and we had the court thing that got set up when counsel finally said, okay, here we're going to make our offer. Until that time, basically she's on the hook for that. But the court did actually make an interesting adjustment for the amount the attorney claimed. They actually, they had some problems, some documentation, some issues, but they actually did allow a certain number of hours that wasn't really being listed as claim for the amount of time the attorney had spent putting together the qualifying offer. The IRS was on the hook for that, right? Had they accepted the qualifying offer initially, had they simply conceded when that was presented to them, they would have skipped having to pay any legal fees. But having now, gone by that path, not accepted it, and as I recall, the rule, it needs to be open for 90 days. Absolutely. The IRS says, yes, you've totally agreed, you're accepting it. So that's why that's why in this case, they weren't going to offer $1 more. That's a judgment of counsel. And that's a judgment that's basically, you got this right, because, if we settle this ultimately, but it's for $1,000, your legal fees are also going to be sitting out there, right? And again, a case like this, which most likely the attorney was taking it, understanding that it may not be likely that, she's going to be able to pay the fee that's being incurred. That's why it's so important to have a qualifying offer and for the counsel to have realized, he or she had a killer strong case. And therefore, the proper thing to do was put the zero in. And man, if the service missed that signal, that's their problem. That's kind of how the court looked at it. Okay, how to end up paying your client's tax liability for them. Okay. Federal priority statute and the officer liability of a corporation, even that officer themselves has no direct financial interest in the corporation. This is United States of America versus Isaac Neuberger, civil action number EA 222997, EA 222997. This is from U.S. District Court for Maryland, and the opinion came down also on October 32. October 32 is a popular date for opinions. Okay. Now, this is the personal liability of an officer for debts to the United States, to the Treasury, under Title 31 United States Code, Section 3713B. In this case, we're looking for the personal liability of a corporate officer, Neuberger, for the corporation's unpaid tax debt under this federal priority statute. Now, Mr. Neuberger, as the sole director and president of Lechem, he was aware there was $1.4 million of tax assessed directly related to disallowed loan interest deductions inside the C corporation. Right? Now, the statute in question, 31 United States Code Section 3113, was ruled by the court to be properly asserted because the asset transfers involve creditors not covered by the Federal Tax Lien Act. It was a related party. These are all corporations that were set up to deal with situations involving, Mr. Neuberger was an attorney, was involving his clients, various transaction structures, etc. And it was an attempt to get to offset the income coming in here with the loan interest deductions that supposedly they were paying for having borrowed on this stuff. Right? That's the way it worked. Now, there are three elements for a federal priority statute claim that must be shown, right? Number one, the debt must be due to the United States. Okay, a federal tax debt is a claim of the U.S. government. Bingo. First hurdle cleared. Second, the debtor must be insolvent when the assets were transferred, right? In essence, the person we're trying to get the money from had to have been involved in a transfer that made the corporation insolvent at a time when he was aware it would make the corporation insolvent. Now, the solvency analysis does look at this $1.4 million tax liability, and here's the catch. The attorney was betting on, he claimed there was a $1.25 million receivable asset out there from related companies. Now, the problem the court said is the existence of that asset could not be confirmed and was never shown on a balance sheet. It wasn't shown on Schedule L's on the tax return. So while the attorneys say, we're solvent because we had a right to get $1.25 million back from these other related companies, you got to have documentation that there's a legal right there. And it doesn't help that you didn't say anything about this right on your 1120, right? It's kind of bad. Finally, there needs to be a triggering act. And in this case, the corporation's transfers of $8.8 million to repay a related party loan constituted preferential transfers that should not have been made until the federal claim was satisfied. So because he was the officer, he approved these transfers, and these transfers rendered the corporation insolvent because there was this $1.4 million tax liability out there that now the company didn't have any funds to pay because it had paid off amounts that it owed to related companies. Well, the attorney's on the hook, right? Mr. Neuberger's role as sole director, president, and treasurer qualified him as a representative under Section 3113B of Title 31. That means, hey, you're on the hook. He had knowledge of the superior U.S. tax claim. It wasn't like this is something he wasn't aware of, right? In fact, probably suggestion was that he was very aware, and that was part of the reason why this structure was done, was going to be out there. Uh, you know, he was aware of that. He was integral to the development and execution of the repayment plan. So, he designed the plan. He knew exactly what was going on. And he authorized the transfer of $8.8 million to the private creditor, Nightingale-related party, before he paid the United States government. Therefore, he's now liable to the extent of the payment made to the private creditor. Remember, he made $8.8 million to private creditor. Right now, the IRS is asserting $1.4 million, then interest, tax, interest, etc. Yeah, he owes that out of his pocket, right? That's the key. So, again, you have to understand, it doesn't mean a officer can still be liable even though they have no economic interest themselves. He was not, he was the guy appointed president. So, it kept his client away from being the person in control, which he probably just thought was going to be a dead to rights, that this wasn't going to work. So we're presuming that he thought it was okay. I'm going to presume that he knew about this statute and he thought it was going to be okay. He thought the argument for solvency would hold up. And yeah, that didn't work. Next up, how saving U.S. trustees' fees may have not worked great for a taxpayer in a bankruptcy case. The termination of the automatic stay for collection activities, how is that impacted if you have an administrative termination of the bankruptcy for administrative purposes? So this is a bankruptcy case of Henry Benjamin Douglas Morris, case number 12886, JDW. This is from bankruptcy courts for the Northern District of Mississippi, and this decision came down on the 28th of October. The question is, does the automatic stay under the Bankruptcy Code, Title 11 U.S. Code, so Title 11, Section 362A, remain effective after a Chapter 11 case is administratively closed to avoid U.S. trustee fees? The trustee is a person involved in supervising. The trustee appointed is going to be paid fees for all the period that they're doing it. And so in many cases, in a small bankruptcy, or when it's just execute the plan, you'll see that they will go to court and get what's called an administratively close the estate, the bankruptcy case, right? So the debtor's plan allowed administrative closure before the payments were complete. That was part of his plan, approved by the creditors. The case was closed, therefore, in December of 2014. Now, the IRS pursued collection actions in 2019 to 2024 for trust fund penalty liabilities assessed post-confirmation. So now the IRS is pursuing, right? This is a creditor. The taxpayer, in this case, is trust fund penalties, it's the individual. The individual believed that, in fact, there was a stay on collections, that the IRS couldn't move against him until he actually completed the payment plan and had that approved by the court. But the court said, no. So here's the catch. The Bankruptcy Code, Section 362C2, dictates that the stay terminates at the earliest of dismissal, discharge, or the time the case is closed. The court notes nothing in the code says anything about this administrative closing and how it is an exception, or would be an exception, to this rule. Therefore, as of December 2014, there was no longer a stay. So when he was assessed trust fund recovery penalties for, the years of 2019 to 2024, the IRS had the right to use all of their tools to collect that, because they weren't still sitting in a bankruptcy that was going to hold up any collection activities. The court noted the administrative closure is not a recognized concept in the Bankruptcy Code. It's one that's been developed based upon what people did because, again, they're trying to avoid those trustee fees. So they go ahead and they do this. So because, it's not unusual, right? Taking this action concurrently triggers the termination of automatic stay under the plain language of the statute. That is a trade-off. If you want the automatic stay to stay in place, you need the trustee to keep getting paid. That is the option the court found in this case. You don't want to pay the trustee, that's great, but this is a trade-off you do. Now, while the court retains jurisdiction to enforce a plan, that's not equivalent to preserving the automatic stay. The court notes, now there have been other cases where the courts have issued separate orders that kept the stay in place. But the court noted that the taxpayer in this case never asked for any such things, right? They never mentioned it. So there was no such order ever issued. So if your goal is to keep basically keep the stay effective, and you want to still have the administrative closure to shut down the trustee fees, the court said that the debtors got to request and obtain an affirmative court-ordered stay extension under Section 105A. If the court doesn't do that, there is no stay. Therefore, now back to the IRS, right? So applying 362C2A, the court determined that the earliest trigger point occurred on December 16, 2014, when the administrative closure was granted, and the case was closed, and that automatic stay terminated then. Therefore, since there was no stay in effect during the period the IRS took the collection activities in the years 2019 to 2024, the IRS did not violate the stay. There were no sanctions, and they get to keep what they took. Right? There was no sanctions. They can levy. They can do everything else because the stay's gone. Yep, you're still paying out that old Chapter 11 bankruptcy plan, but the stay disappeared, in essence. Interesting case, more of a bankruptcy case, but if you are in a collection situation with the IRS and the client's going through bankruptcy, you probably want to make sure, and the question comes up about administrative stay, then yeah, it might be worth, asking, do we see, what, as counsel considered this case? And, does counsel consider it wrong? Is there overriding authority, like here in Arizona? If it's an Arizona case for me, would there be something else out there? Or is counsel going to request the court orders to extend the stay? Do they believe they'd get it? Or court activity, again, not really directly related to the tax, but this is a case of an injunction for violations and a civil contempt finding against a tax preparer. This is the United States of America versus Kevin Hardy. This is case 05-CV-3847. This case came from the Southern District of New York, and the order came down on October the 28th, 2025. Now, many years earlier, 2007, Mr. Hardy was permanently enjoined from acting as an income tax return preparer due to prior unlawful conduct. It was one of those weird structures where he was filing claims for refund based on by supposed reparations credit, for for descendants of people who were formerly slaves in the U.S. And as we know, there is no such credit. Well, so he was doing this. So the IRS caught up with him, government caught up with him. They took him to court in 2007. It was issued a permanent injunction against him acting as income tax return preparer. Now, as you might guess, it turns out in the interim, all the way through today, he just kept continuing as preparer. His claim is he thought it only meant he couldn't be involved in making claims that there was a credit, that credit existed, and filing those credit claims. And nobody's suggesting here that he did that. Rather, they're saying what you agreed to was not just simply not to make false credit claims. What you agreed to was not to be a return preparer. That's a very different thing. That's a broader rule. So, for there to be civil contempt, a court has a right to enforce its orders, and it can use civil contempt, which basically is the judge becomes, in some ways, judge, jury, and executioner, right? Was that prior order clear and unambiguous? Right? Was the proof of compliance that the government's bringing in here, does it demonstrate a reasonable certainty that the order was violated he agreed to? And did the basically, did he, the contemnor, cases are always fun with the language and law uses in a case like that, Mr. Hardy, did Mr. Hardy not diligently attempt to comply with that order over the years? Now, what the court found is, obviously, they said, it's clear, do not prepare returns, do not be a return preparer. That is way more than just don't prepare fraudulent claims on a reparations credit that doesn't exist. That's a very different ruling, right? The IRS had all kinds of evidence because he filed returns and used a PTIN that's clearly in his name. So we're pretty clear he says I was being a paid preparer. He didn't really deny it either, so that's also part of it. And the court said, no, you're claiming you misunderstood it, but the language was way too clear. You didn't diligently, so either you never read it, which is not a diligent attempt to comply, or you just decided you'd ignore it, and it's unfair, etc. And people think that way, unfortunately. This is unfair. I know I agreed to it, but I really shouldn't have. It was horrible. It was terrible. Rather than trying to see if some legal action could be done to kind of remove some of these restrictions, you just go ahead and say, I'm just going to do it. And he went many years doing it without anybody saying anything. I presume that something led the IRS to his attention again. And yeah, somewhere he attracted their attention. And that was when somebody looked back and said, hey, wait, this guy shouldn't be preparing returns. He agreed in 2007 not to do this. So the IRS is not required to show that the conduct was willful. So here's the catch. Maybe Mr. Hardy simply was not the brightest bulb in the bunch, right? Maybe he honestly believed, because he never really read the order, he honestly believed he was able to do it. He didn't really understand he was violating it. We can leave it to you because, of course, to a certain extent, some of this becomes what I tend to refer to as the cheek defense, which is more of a criminal defense, but kind of in this case, same thing. We're trying to say, well, I'm not bright. I'm not very bright. I really didn't understand this. And in essence, the Supreme Court ruled that you can't charge somebody with criminal tax evasion, that a cheek defense, in essence, I'm an idiot. And even though it's obvious to people of average or even below average intelligence that this really was criminal activity, I had an obligation to file returns, etc., which is Mr. Cheek's problem. I was just so dumb that I honestly believed I did. Now, the interesting part about Cheeks was, of course, that even though it got sent back and his case was sent back to criminal court for retrial, to U.S. District Court for retrial, yeah, the jury didn't believe he could be that stupid. Okay. But in this case, we didn't even worry about that. Basically saying I was dumb is not a defense if they can show all three of these, right? The order was clear. And the big problem here, if you are that dumb, right, so you didn't willfully violate it, is that you just didn't really take the effort to have somebody look at this, help you understand what it meant, and then say, I cannot prepare returns, which is what the order said. So generally, as we said, the court found that order clear, right? Unambiguous, rejected his argument that only applied to his previous specific fraudulent scheme. Yes, that's what got the attention, but the order was broader than that. He knew that. He should have known that, right? By his non-compliance, 5 taxpayers confirmed that Hardy prepared returns for them after 2007. He used the same P.O. box address as the business entity mentioned in the initial complaint, so he kept that open, right? payment records, the Venmo referenced taxes for recent years when he received those on his personal Venmo account. And he testified that he was operating income tax preparation business in 2019, 2020, 21, and 22. So he was operating a business he's admitted for 4 years. And remember, the 2007 order never said it terminated. So bottom line, court says, you've admitted you admitted that you didn't comply. You may claim you didn't know you weren't complying, but you've admitted, honestly, compared to what this says you can't do, you did it. There's no question, right? The court found him in civil contempt for persistently ignoring judicial order for over 16 years, right? So some of these went back earlier to what he admitted. The court had a coercive remedy is mandated too, because the court ordered him to basically pay back all fees he had received since 2007 for preparing tax returns and to have comprehensive financial disclosure all the way back. And the judge also told him that if he doesn't cooperate there, she may impose additional sanctions. So, just take care. As I said, she is an interesting judge in terms of history, but she also was a judge that was in charge of the Milken case decades ago. So, yeah, she's been used to some high-profile cases over the years. So he was required by November 10th of this year to provide a list of all tax preparation customers and fees charged since April 16th of 2007 when they issued the initial order. And he agreed to it. Provide all financial records, bank statements, Venmo records, etc., necessary to verify his statement of who's there, and to disgorge all fees. So basically, going to have to pay back under that identified P10 since the injunction date. So, bingo. As I said, presumably, somehow he came to the attention of the IRS again. Don't know what was going on, why he came to attention. Could have been something as simple as just one of his clients got an exam. It could have been he was representing a client. It doesn't say he's an EA or CPA. That wouldn't necessarily be relevant to this case, but let's assume if he was, he might have applied for representation. And, whoever's working with him at the IRS says, hey, wait a minute, I'm looking up the history of this guy. And there's a court case against somebody named this who was operating from that same P.O. box. I think we got an issue here. So it could even be if he was just had the authority to, disclosure authority, it could have even triggered up that way. Next up, another bill has passed the House and Senate. Well, it passed the House a while back because, as you've known, the House hasn't been in session for a while. Basically, by the time you hear this, it will have been over a month since last time they were in session. So, yeah, well, it actually been there before that. In any event, so, yeah, they're not in session, but they had passed this before. The Senate passed identical bill. This is H.R. 998, the Internal Revenue, Math, and Taxpayer Help Act of 2025. October 23rd, the Senate passed it. It's now been sent back to the House, by the Senate. The Senate noted that they passed it. And generally, at this point, the House would transmit it to the President. Now, the problem has been, since the 23rd, the last I checked, it's still sitting there waiting for transmission. I am thinking that it's very possible it can't be transmitted until the House is back in session again. So it may take a while to get this signed. Just saying, right? So here's the mandates, assuming this becomes law. Seems likely it will, right? It's going to have enhanced specificity and transparency for IRS notice issued under Section 6213B1. Now, it's going to apply to notices sent, 12 months after the date of enactment. We are still waiting on date of enactment because we have to wait for the bill to go to the president's desk and the president to sign it, or allow it to go into law without a signature. Or I suppose get rid of it by pocket veto if it actually gets dragged out that long. Hopefully it won't get dragged out that long, right? So in any event, probably sometime late 26 is when this will start applying to notices. Doesn't mean the service could not do it earlier. Just means it got to have it going by then. Okay. Now, any notice must describe the mathematical clerical error in comprehensive and plain language. Right? It's got to be something that an average person I presume, since apparently the average American has a 6th grade reading comprehension level, yeah, that stat's been around for a long time. Basically, you're right to that level. In general, if you're writing a general purpose document, for the general public, you got to be that level because, if you go above that level, you're beyond the comprehension of the majority of the people who would be reading it. So we got to get it into that level. Okay. So basically things like that. Now, like I said already, it was if you got to watching the video here, talks about the pending of signature. Yeah, it's got to be transmitted to the White House and the president has to sign it. That has not happened yet, so this is still a pending bill, right, in that case. Now, the error description must include the 4 explicit components. The type of error in question, the Internal Revenue section to which the error relates, a description of the nature of the error, the specific line on the return on which the error was made. All 4 of those must be part of the notice, the error description. A notice providing multiple potential alternative errors is insufficient. You need to have actual listings of errors. Now, all errors that apply could be listed, and you explain them all, but you can't just the IRS cannot come up with this general purpose notice that has all kinds of random errors, and therefore they never have to identify what the real one was. They got to identify ones that are real. They can't just have that. It'll be an improper notice if it appears that there were arguments there was an error or an error was being claimed under provisions that never would have been an error for what we're looking at here. Wasn't there, so that's wrong. Now, it has to contain an itemized computation of the direct or incidental adjustments made to a comprehensive list of financial categories. Some of them include AGI, taxable income, various refundable and non-refundable credits, and carry forwards are in there. The date by which the taxpayer must request abatement for penalties and or any other actions here must be displayed in a highly visible manner in a bold 14-point font. Very exact. And immediately next to the taxpayer's address on page 1 of the notice. So next to the taxpayer's address on page 1, it should say, the last date of request abandonment will be, and have the date on there. So it's very clear when they've got to respond. You don't have to read through 3 pages of letter to figure out, how long they've got to do this. The secretary must establish these procedures, written, electronic, telephone, or in person, for abatement requests within 180 days of enactment. So we're going to have more detailed information about, and that'll be binding on the IRS, about the steps involved for requesting abatement. Within 18 months, the IRS must implement a pilot program testing the delivery of these notices by certified or registered mail with e-signature confirmation. I like, and I'm not sure I like that one. Why I say I like it is, it's definitely going to be, it's not going to be good enough for them to kind of just, say, hey, notice went out. This is beginning to, at least they're testing. We're going to assume Congress would then enact something of this sort. That would not make a notice valid unless the IRS, could present proof of delivery, right? The e-signature proof of delivery for the item mailed out. That's not in here right now, but we're going to assume they might do it. And the IRS must report on the effectiveness of certified mail and its impact on taxpayer response and abatement rates. And if that goes well, we could do it. Now, why you don't like it is your client's going to whine, because the IRS showed up. Now, the problem is many people have nobody at the address they get mail during most work days. What's going to happen is, the Postal Service is going to say, hey, we got this for you. You got to come down to the post office and sign for it. And they'll be grumbling about that. Because again, if every notice, all those CP 2000 notices are going to be required to have this signature, if that's an error, and I think it is, let me say an error. When clients get CP 2000 notices, there'll be a lot of walking down there. And to be honest, something I think you and I need to consider is Sometimes we get CP 2000 errors for things like, we listed estimated tax payments that weren't made. And sometimes they're just a missed meeting of the minds. And it's late in tax season. It just came in. The client's screaming they don't want to go on extension. So you rush it out by April 15th, right? And you just assume they paid their estimates, or you assume they didn't. And of course, the assumption's wrong because it was not time to confirm with the client, or the client was not responsive when we tried to get the thing. And so the only way to finish is to finish it. Well, then you're going to get a CP 2000 notice, and then the client is going to potentially properly complain that they have to go down there and retrieve this thing, and it's going to cost them money because, let's say they're an attorney, they have billable hours, but you can't bill time standing at the post office in line waiting to sign for a certified mail notice from the IRS. We could find complaints. Finally, interesting case. Not that this is likely going to apply to you a lot of times, but what's interesting is it illustrates that the service can take contrary positions even with the same transaction regarding different taxpayers. This is the second case in this structure. This is the case for the trust for trusts under the trust of Charles G. Berwin Trust, for the benefit of David Berwin Jr. and various others, versus Commissioner of Internal Revenue Service. This is case number 242360, and then a whole bunch of others. It was from the Third Circuit, who sustains the tax court's position in this case, and it was issued on October 30th. Let's talk about this case, what it is, why it matters. This question is whether a deferred $191 million settlement payment for minority shares redeemed in a short-form merger under state law is subject to imputed interest under the Internal Revenue Code Section 483. Now, the goal of Internal Revenue Code Section 483 was to prevent taxpayers from converting ordinary interest income, right, into capital gains by failing to provide an adequate stated interest rates in what were essentially delayed payment or installment contracts. Now, the taxpayer argued that the sale occurred in 2002, the date of the settlement payment, not in 1999, the date of the merger, where we're going to have this dispute over, what was the proper amount to pay for the minority shares. So they're saying, look, because 463 does not apply, or 483 say, does not apply if the payment occurs in the same year as the settlement, as the agreement was entered into, right? If it's short term, then we ignore it. But in this case, if it actually is representing a 1999 liability, then we have 3 years running. And in this case, I believe it amounted to around $30 million was the amount that was being treated as interest on this particular structure. What was going on at that time with the remainder becoming into capital gain calculation. So we're looking at capital gain versus ordinary income on a significant sum of money. And as you're probably aware, 37% is higher than 20%. So yeah, we have a little issue there. Okay. Now, what the court looked at was state law in this case, right? And it said under the state law in question, under which this, this particular merger took place and the minority shares would have been redeemed, that occurred in 1999, the date the articles of the merger were filed, making the merger legally effective under the state law in question. As I recall in this case, the state law in question was that of New Jersey. 1999 merger agreement, executed by the corporate entities, constituted the contract for the sale or exchange of any property, even though the shareholders dissented and we had 3 years of litigation, right? 1999 merger agreement legally affected the sale and created the payment obligation. It established the basis for subsequent payment, and a 2002 settlement merely fixed the disputed price term. So since the sale occurred in 1999, the payment occurred in 2002, Section 483 was triggered. We have deferred gain. We have a deferred sale contract. So the conclusion of the court, it affirmed the deficiency. Approximately $31 million settlement payment must be recharacterized as ordinary imputed interest income. So there'll be a lower capital gain by that amount, but increased ordinary income by that amount. That's generally not a good trade, right? Long-term capital gain traded for ordinary income. Very rarely would that be a good trade, right? Now, this same question, was there an interest component of the payment, was raised by the entity that paid the claim. This was a company whose name was changed shortly after the merger, so it is under the name of ColorCon Inc. versus United States. If you actually read the first case, the case that came out this year, you're going to find a different name for the party that eventually emerged from this as the merger, entity, which redeemed out the minority shareholders. But it renamed itself. So ColorCon is the same thing as the entity you'll hear named in the actual, opinion that you have coming out here. In that case, the IRS had opposed the buyer's claim there was any interest in there. They said, no, that was all for redeeming stock, which doesn't really give you anything, right? You redeem stock. You buying back your own stock doesn't really give you anything. You just sent money out. But the court found there that no, there was a summary judgment for the buyer saying that legally 483 applied. And therefore, a portion of what the buyer paid represented interest expense. Now, remember, they are arguing what the IRS is arguing here is exactly what the seller, right? Basically, the plaintiff in the case that got decided this week is arguing. This was a 2002 transaction. There was no three-year period where there was a liability. But having lost on that, the IRS hauled the other entity into court to now have them pay the tax, right? So ColorCon got a $31 million deduction. They would have gotten none had it been held the other way. So now the IRS says, well, if we don't do something about the fact, because we know the trust didn't report this, but they report as capital gain, we need to actually get a separate case running against them in case we lose, and that's a whipsaw case, right? So the IRS will take inconsistent positions against, parties on opposite sides of a transaction whenever there's a risk of a whipsaw against the government. Now, that does also mean that you need to be cognizant of the fact if you're on the other side of a transaction like this, and the other party is taking a tax position that is to their benefit on the characterization of what happened, but may not be to yours, that you need to keep up on that and be aware of that situation unfolding, right? Therefore, it's probably helpful in a case like this to at least get some indication from the other side of how they feel the proper tax reporting will be for this. Because I have a feeling, not 100%, because it could have come the other direction too, but I have a feeling that had ColorCon not claimed the interest deduction, that was probably what got the attention of the service, may never have noticed the fact that the trust didn't pick up the income. But if they had been the other way, then here's the other problem with whipsaws. Let's say you were ColorCon, right? You become aware, that the other party has, essentially, the IRS is going after the other party for this should have been interest income. Being aware of that, you may consider, if you didn't claim the interest deduction, to make your own protective refund claim and say, this depends. The IRS, we have been told by the trust that the IRS is pursuing them, and trying to claim that part of this is ordinary income, interest income. Well, if that's true, if in fact the service prevails on that, we are going to be claiming, that we should get a deduction to prevent a whipsaw, right? To prevent the IRS from getting taxed twice, right? We didn't claim a deduction, but they still collected the tax. So we get it back. So keep that in mind. Well, this has again been the current federal tax developments here for the week of November 3rd. Current federal tax developments, as always, brought to you by your state society. My email address, as is there at the top of the slide, if you have the slide up to date, is edzollars at currentfederaltaxdevelopments.com. You're watching the video version, which we have on the website. Also posted to YouTube. You want to see it there. If you're not paying for YouTube, you may end up with commercials. I forget how that works anymore. So whatever. But if you don't like that, it's not coming through there. It's coming through Vimeo on our site, the main current federal tax development site. You want to watch it there. You can do it with Vimeo, and you shouldn't have to worry about your status if you're paying for YouTube Premium or not. It'll work there. I'm also monitoring the websites, the Connect sites for Arizona, Idaho, New Jersey, Illinois, Minnesota, and Washington. So I do keep an eye there. So if you have any questions, you post them there. I'll try to keep my eyes open for what's going on. And if I think I can help, I'll respond. But otherwise, we're here now. At the end of the week, great day. We've got it. We're now into November. So really what's coming up next, main due date, is the final extended due date for not-for-profits, I believe is our next upcoming one, on November 15th. So if you got all those extended 990s, I assume you're working on them now. You get them taken care of. Otherwise, though, we will see you next week. This is the good tax planning time of year. And by the way, as I'm very aware right now, of the time of year that people tend to take their tax updates or have other continuing education, because I did a bunch of that this week, spoke at a conference, gave two 2-hour presentations for CPs to state societies, and then gave a series of 2 days of 2 4-hour sessions. So did those. Going to be doing some more things this week with a couple more sessions, a conference, some work for a firm, etc. All kinds of neat things on continuing education. So all that fun starts going out this week. And my own office is getting ready to move, right? We're going to be relocating. So bingo. That's always fun. Moving is so much fun. Not really, but it is. So we're going to be doing that. That'll be fun. We'll be in a building with the Arizona Bar Association. They own the building. So we'll be there with their location. So hey, we're going to meet attorneys quite a bit. I take it now walking through the lobby. We'll see what happens. Anyway, we'll be back next week. Should have one more week when I can record in the office we've been in for years. I think after that, the next weekend's a little more interesting. But we'll take a look at where I'll be doing anything at that point, and working our way toward our new location. So we'll have fun. Not terribly far from our current office, so. Just one of those things. Otherwise, we'll see you again next week with more current federal tax developments.